Josh Gellermini with Jones Lang LaSalle. The multifamily sector has really leapt to the top of investors' target lists in 2010 as there are several fundamental driving forces making the property type more attractive than perhaps some others at this juncture in time. Now, traditionally speaking, multifamily does rank second to office in terms of overall national investment trading volumes, and while that's still the case in 2010, apartments have really closed the gap this year, and there are a few forces that are really behind that, which I'm going to mention now. First, the availability of debt financing has been greater, although it's increasing now for almost all property types. For multifamily in particular, the presence of the federal agency-backed lending by Fannie and Freddie has really increased availability throughout the year of financing, increased options, and also has had a beneficial impact on mortgage interest rates for multifamily. Secondly, and perhaps most importantly, has been the turnaround in the labor market, which we've seen, and although it's been fitful at times, and it hasn't lived up to economists' expectations early this year, there has been a definite positive impact, and we've seen that market fundamentals essentially bottomed for the multifamily sector at the very end of 2009, with vacancy rates peaking early in the first quarter of this year, of 2010, and then followed perhaps 3 or 4 months later by rental rates bottoming. And since that time, we really have seen a steady improvement, and perhaps an even increasing pace of improvement as we've gone throughout the year. In the third quarter of 2010, that recovery actually accelerated further, and the recovery in fundamentals in the apartment sector are clearly outperforming that which we're seeing at this point in time in the other 3 primary sectors. Another factor layered on top of the improving macroeconomic climate and jobs pictures and the increased availability of financing has been the increasing struggles actually in the for-sale housing market, the continuing foreclosure crisis, as well as the potential for a modest second dip in home prices, which many expect to appear at the end of 2010 and perhaps the early part of 2011. That's actually helps in a couple of ways, but one way I'd like to mention is that for millennial generation renters who perhaps now feel a little bit more confident about job prospects and are increasingly leaving their parents' homes and roommate living situations to re-enter the rental market, also perhaps don't feel pressure to buy a first home right now, as housing affordability is forecasted to remain intact, and there's really very limited fear of being priced out of the home market, at least for the foreseeable future, measured in 1, 2, perhaps 3 years. So we see all of these trends really remaining prominent into 2011, and frankly, it all spells good news on the front for both market fundamentals and for the investment performance for multifamily. And we do expect it to remain at the very top of investors' wish lists for 2011. Thanks. That's just something to think about.